for the ASSOCHAM and EGROW jointly held shadow monetary policy. Now, with this, I would request our colleague at ASSOCHAM, Shri S.C. Agrawal, to welcome, and then he will hand over the baton to the chairman of EGROW Foundation, Dr. Arvind Virmani. Mr. Agrawal ji, please.
Agrawal sir, please unmute yourself.
Hello, am I audible? Yeah, good evening, everyone. First of all, I would like to congratulate and thanks ASSOCHAM and EGROW Foundation for organizing this discussion on monetary policy, and thankful for giving me an opportunity to deliver welcome address and opening remarks. Dr. Arvind Virmani, former Chief Economic Advisor, Government of India, and Chairman EGROW Foundation, as usual, is conducting the difficult job of session moderator. We, on behalf of ASSOCHAM and EGROW Foundation, welcome him for giving his valuable time today. We also extend our welcome to other panelists, Sri Sachinder Nath, Executive Chairman and MD, EGROW Capital, Ms. Upasana Parmar, Senior Economist and Senior VP, Kotak Mahindra Bank, Sri Abhik Barua, Chief Economist and Executive Vice President, HDFC Bank, Sri Siddharth Sanyal, Chief Economist, Head Research, Bandhan Bank. We are also grateful to Dr. Charan Singh, Chairman, ASSOCHAM National Council for Banking, and welcome his presence in this seminar. Amidst of third wave and hardening of retail inflation, we expect MPC should keep status quo on interest rate. I think and they will like to wait to watch macroeconomic situation of the economy and on this bi-monthly policy, which will ended on 6th August after 3 days, 4th, 5th and 6th. So higher commodity prices and rising global prices in some manufacturing countries in the world. Production, yeah, some disturbance is going on. Please mute yourself. Production cost is rising. So due to this rising inflation, which MPC is thinking that due to fuel prices, inflation is increasing. So chance is that inflation will persist at this elevated level for some months, and it will be eased in third quarter, financial year 21-22. And when Kharif harvest arrives in third quarter.
Agrawal sir, you are muted. Hello? Sir, you are on mute.
Can you hear me properly?
Please unmute yourself, Agrawal sir.
So, am I audible now? Yeah.
Mr. Agarwal, before you start, it is, I can't hear much because there is a constant disturbance, or this has to be resolved. I don't know who's kept himself unmuted, but this is getting to be very, very annoying because I can't hear anything of what you're saying. So if Kushagra, someone can just take the initiative and just maybe mute everyone except you or whatever can be done, because this is very, very disturbing.
I think, yeah, a lot of disturbance is coming. So should I start again afresh?
No, you can. So we listen to the first bit, but I think this disturbance should be stopped.
Dr. Rajesh and Kushagar, please make sure that everybody other than the speaker is muted. And Mr. Agarwal, you can continue. I can still see that there are some noises coming in. So requesting everybody, please mute yourself. And Kushagar and Dr. Rajesh, need be, then you mute everyone.
Yeah, I
And
think that's
only
the
allow
best
the speaker.
way forward. Yeah.
Mr. Agarwal, please continue. We have partly heard you. Yeah, please continue.
Yeah, RBI, I mean to say RBI likely to maintain status quo on interest rates amid fears of, still disturbance is coming. Still disturbance is coming. Kusagar, are you there? Kusagar Doshi, are you there?
Yes, sir, I am.
Lot of disturbance is still coming. Please take care of that.
Mayank, kindly mute all, Mayank. Except for Agarwal ji, kindly mute all.
Okay, sir.
Yeah, RBI likely to maintain status.
Agarwal sir, you are on mute. Please unmute yourself, sir. Sir, please unmute yourself. Sorry for the disturbance, sir. Please unmute yourself, sir.
Is it okay? Abhi still disturbance is coming. Kusagar, maintain it. Lot of disturbance. Yeah.
This is shadow monetary policy. Now he has just finished the shadow. ये चक्कर में हमारा
Yeah, RBI likely to maintain status quo on interest rates amid fears of third wave of coronavirus pandemic and hardening of retail inflation. And RBI would like to watch the macroeconomic situation for some more time before taking any decisive action on monetary policy. The RBI is scheduled to announce its bi-monthly monetary policy review on August 6th at the end of 3-day meeting from August 4 to 6 of the MPC. Higher commodity prices and rising global prices post the robust recovery is a part industrial countries have implication on production cost. We expect the RBI to be in wait and watch mode as it has elbow room to maneuver monetary policy. In inflation is because of the fuel prices which will get normalized in some time and the inflation pressure will ease. The sense is that inflation will persist at these elevated levels for some more months before easing in third quarter of 21-22 when the kharif harvest arrived in markets, a recent RBI article said. Growth concerns and weak demand conditions owing to impact of second wave of COVID on employment and declining labor force participation rate combined with maneuvers on any change in stance by the MPC.
Subhash ji, we just cannot hear anything. Can you check, have somebody else also in your office have logged in through your email ID?
I think am
Sir,
I
I'm checking
audible?
on that, sir.
Yes,
Am
because
I
all,
audible?
yeah, but all participants are on mute, sir, except yourself. So is somebody else also have logged in through your email ID?
Yeah, it seems like an
I
office. There's some discussion going on in some office where the computer
Yes.
is probably.
Yeah, so
Yeah,
but
here in ASSOCHAM it is going on. Not in my office.
no, somebody, because everyone is on mute, Subhashji. At the moment, I can see that only there is a user called HP who is unmuted right now, and you are unmuted.
Yeah, I'm sitting.
Can I request the host to mute everyone so that we get to know that after that whether this stops or not? Because somebody is.
I muted everyone, sir.
Mr. Joshi, just yeah.
Is it okay now?
So, it is not. Can you host mute everyone for a second, and then Subhashji can unmute himself. Once
Yes,
please
sir.
mute
Yes, sir.
everyone. No, it's not possible. Everyone is muted. Still, the sound is coming.
I will resolve this issue in a couple of minutes.
Yes.
आकाश है नहीं वो तो 10 ही था कौन सा वाला था 740 हाँ तो है ना आकाश कितना दिया उसको ट्रांसफर में अभी दे रही हो 4.5 एपी वाले में 4.587 तो उसको दिया 785 685 95 महाराष्ट्र किसमें है चार सुबह में कुछ दिया है काम
This is strange. Everybody is muted, and this seems to be like Pegasus.
चरण सिंह जी, किसी ऑफिस के अंदर ये कोई डील वगैरह हो रहा है बैकग्राउंड के अंदर?
ये I think
एपी वगैरह सम लेडी वॉइस आ रही है बार बार.
Yeah, I think so. This conference admin user ID has been logged in somewhere, and that's why when we are muting, that person is not visible, but it's still all the voice from the office is being picked up.
We request all the participants. There is some lady voice who is doing some deal 685 Andhra Pradesh, something like that. Please ask her not to waste time of all other participants here.
Yeah, but
I'm sorry to intervene.
But problem is that everyone is on the screen is muted. So right now, in participant list, only Mr. Mitral, you are unmuted.
I am talking. That's why I have unmuted. No?
Yeah, absolutely. But still the voice is coming. So that's the problem.
Now, currently it has stopped. I think someone has got better sense has prevailed. Let us start and let us see if the voice comes again. No?
Agrawal ji, requesting you to please continue.
Okay, thank you. Further tranches of GSAT and open market operations can be expected to help the yield on government securities from rising as there is a constant upward pressure on it owing to higher borrowing program of government and inflationary pressures. A BOFA global research report said we expect the RBI MPC to look through the transitory hump in inflation and stick with a unanimous dovish pause in the upcoming August 6th policy. The MPC is likely to revise up its financial year 22 average CPI inflation forecast slightly from the previous 5.1% and flag potential upside rise. the CPI-based retail inflation was 6.26% in June 2021 and 6.3% in the previous month. It was the sixth time in a row that the MPC maintained status quo on interest rates. So, important takeaway, if we see the last credit policy declared June 4, 2021, repo rate remain at 4%, reverse repo rate remain at 3.35%, MSF and bank rate remain at 4.25%. RBI expects real GDP growth rate at 9.5% in 2021-22. RBI had predicted CPI financial year 22 at 5.1%, which again I think they can increase. Monsoon should remain normal and growth should remain, because due to this normal monsoon and business resilience can provide a tailwind recovery. So I think RBI has done some liquidity support window for contact intensive sectors till March 2022 with up to 3 years at the repo rate. Plus lending to hotels, restaurants, tourism, travel operators, adventurers and heritage facilities. And they have announced 16,000 rupees SIDBIL loan for own lending and refinancing to some small scale industries and individuals. And they have also said that restructuring limit is increased from 25 crore to 50 crore from August 2021. So these are the some key takeaways from the last RBI. So at the end, I can say RBI should maintain interest rate status quo. Thank you very much for giving me the chance. Thank you very much. Over to Dr. Karan Singh.
With the welcome address from Mr. Agarwal, we move on to starting our session. The chairman of EGROW Foundation, Dr. Arvind Virmani, who also happens to be the former chief economic advisor of our country, is chairing the shadow monetary policy. Dr. Virmani, to conduct the proceedings, please.
Thank you. Let me, as usual, start with a brief overview of the economy as I see it, before I ask the panelists to speak on their specific analysis and areas. So I basically have about 5 or 6 points. The first one, of course, is a point I have made, I think, for the last in the last meeting also, and with the RBI governor. Of course, let me step back a little and say, we had a year ago, more than a year and a half ago almost, or a year and a quarter ago, we had talked about the lockdown and transition period and normalization. So clearly, by the end of the year, normalization in fact had occurred by March, and that is clearly visible in the data. And then the second wave started, and in a sense we were thrown back into the transition. Now, in the last meeting, as I was saying, I made this observation that the forecasting seems to go with the COVID cycles. So every time there's an increase in COVID, GDP forecast go down. When there's a reduction, GDP forecast go up. So there seems to be a high correlation between the COVID cycle and the forecasting cycles. But we, in our analysis of the second variant, which we put in the EGROW Foundation research, we had very clearly indicated, I think the paper came out, Charan, in May or something. Yeah, where we had said that this is a new variant. It is not part of the old wave, which is more or less over. That and gave something called a double S-curve model, which showed that the Delta variant would spread very rapidly and then decline as rapidly. And by the end of last month, that's basically what has happened. I'll come back to the fine points of it at the end. But the key point we made was this, that people were focusing on the wrong issue. It was not incompetence of the government. It was not as if suddenly everybody had, of course, there was an element of carelessness, but it was the new variant. That's the key point we made. And now, after it spread to the UK, it spread to to Indonesia, to other countries of Southeast Asia, USA, and even back to China now. This is 100% clear. You know, this is something we talked about. We said, don't do the wrong analysis and get the wrong conclusion. You have to focus on the fact that this variant is highly transmissible and much more severe. We even gave an index in our paper. Of course, which was not the medical index because we don't do medical analysis, but based on our model, we had an index of severity. And our point was, this is the nature of this variant. Okay, so that was the key thing. Now, based on this, we gave an economic analysis saying that Q1 of FY22 would be much poorer GDP than anybody had predicted at the normalization time. But Q2 would be much better than people were predicting, purely on the basis of our forecast of the model. And that is exactly how it's played out. So we had remained on, and we had summarized this by saying 2.5, 3 months ago, that our forecast, because of this, undershooting and overshooting and fast recovery, the forecast which we had given, which was 10% plus minus 1%, would still remain valid, but with a little downward bias because the full loss in the Q1 was likely not going to be made up. So that's the first point I want to make. The second point, again connected to our second or third research paper, when we analyzed the fiscal policy during the transition, we had emphasized that during this transition period, there would be logistics disruptions, supply chain disruptions. The logistic disruptions actually happened in India and then spread all over the world. I'll say a little bit about that. Well, it's something called problem of sudden stops and sudden starts. So logistic actually was less severe in India, but much more severe across the world. And the effects of that appears in the logistic cost. Indian logistic cost, export cost only went up by about 20%, but cost from China to US went up by like 100% or more. So this logistic phenomena, which we had identified would happen, of course, we were focusing on India, but the same phenomena has actually occurred in all over the world. And the second point we had made was that there would be supply chain disruptions and what does that mean? The meaning of supply chain disruption was that you would have excess demand in certain products in certain localities, and opposite, you could have excess supply in other localities on other products. But beyond that, as we applied this thing, went in the next few months, what turned out was that an interesting phenomena which was first observed in the US, where there was a shift in demand. There was in India, but we have less data. And so it shows up much more clearly in countries like USA, where the data is very clear, was a shift in demand from services to products. So product demand shot up, which means the logistics required for delivering commodities are completely different from services. And there was a shortage of ships and containers, and those costs went up. Now, as the vaccination proceeds and the COVID dies down, you will see a reverse shift. So you will see a shift back from commodities to services. But this element of disruptions of supply chain remains an important thing to keep in mind, which we had predicted, sometime in July or so, if I remember the date of that paper. And we've seen this in different products across the world, the semiconductor disruptions, the natural resource commodity disruptions, which resulted in price increases, etc. But the bottom line was we had said then also that these inflationary pressures arising from logistic and supply chain disruption would be temporary, that they would have a large temporary component. Of course, temporary doesn't mean 100% temporary. And that again played out in India and in other countries. So we still believe that given the fact that you have inflation pressures arising from these areas of excess demand, and you also have excess capacity in many other things, you will have this rather complex dynamics where you would get temporary increases in inflation. But following what we said, several months later, most people who analyze the US economy have also come to the same conclusion about the US. That's an interesting thing. For those of you who follow the US analysis, it actually mirrored pretty much what we had said. And they're going to the same disruption argument and saying, no, most of it, not 100%, most of this inflation is temporary and will go down over time. Of course, given that we don't know in detail, because it's a new thing about where exactly these disruptions are, which exact products, of course, product disruptions are now clearer. But because of this huge uncertainty still around COVID, it's not precise. One cannot say precisely when this temporary part will end. Next, 2 or 3 points on the macroeconomics of the Indian economy per se. One issue is the export surge. So as usual, in Q1 and now till July, we've had this big surge in exports. So the issue, as usual in macro analysis, arises how much of this is temporary and how much is permanent. Initially, one had to be a little careful and had to assume that much of it may be temporary, but within a month or so, one has got a lot of indicators, both directly from the data and from personal observation, that supply chain shifts are occurring. So a substantial part, I believe more than half of it at least, is due to a permanent shift in supply chains. This has 2 elements. One is that incremental demand. People feel safer now about coming to India for incremental demand, which can in principle be met by India. And the second is the diversification and risk reduction. So there seems to be an increasing willingness to pay the kind of 10-20% higher costs which imports from India require in commodities like engineering goods. I have actually seen a number of exporters doing this, where there seems to be this willingness to, for the sake of reducing the risk and diversifying, they are willing to pay a certain amount of premium. And finally, the third element of this, why it seems to have a lot of a permanent component, is that the repeated China shocks. So it's not just a one-time thing. Earlier we thought Trump effects of tariffs and all. Since then, there have been a number of shocks. Some of them originate China itself. The capital markets actions, a lot. The logistics, they shut down a port, was shut down, so disrupted the whole logistics into that port, the container ships, etc. And now, these reports of 30 cities having Delta variant, where it's very puzzling. They report like 5 cases or 10 cases, and for that they shut down the whole city. So these risks, are hard to quantify because they make no sense from an external observer. So all these risks, I believe, are feeding the diversification into India. And the only thing I would set an aside, though, for the government is they must make sure that they continue. There's a lot of things being done which has been announced, but if this analysis is correct, then both the industry associations and the government must be alert to new bottlenecks that may arise because of certain government policies or bureaucratic issues, and bring this to the notice of the government so that we don't miss out. I think there's a great opportunity which is going to play out over the next year on the export front. So that's a positive for the macro. On investment, all of us have said since the budget that the government capital program, which they increased by 34%, has to lead the way with construction intensive investment, which again was a little disrupted by the second wave, but I'm sure will resume. But the doubts remain about the private investment for the obvious reason that in the normal economy, capacity utilization has again fallen and remains very low. But I believe, and this is what I'm adding to the analysis now, which you should look out for. I think there's going to be a shift from the normal physical, bricks and mortar investment to the digital economy. And in the digital economy, a lot of investment initially goes into what is called the burn. So you're actually not buying a lot of physical equipment, but you're using it to promote the business. You are eating up capital, so to say, and therefore you will not see it in the normal indicators. So this is a thing which one has to keep a watch out for. And the digital economy, in my view, at least for the next several months, perhaps the whole year, is going to lead the private investment surge. So I see that again as a little more positive than one might have done if one looked at only the physical, the normal things where we get the capacity utilization. And finally, on the consumption, yes, there was a lot of disagreement. I was on the optimistic side. Here there are, key dynamics. Are of course, the goods and services thing. I think again, Charan, you will recall we were the first to bring this contact services must be looked at separately from the goods economy, and that dynamics will play out. As I said, there was a shift from savings to goods consumption, and as vaccination proceeds in any economy, whether it's India or any other, there will be a gradual shift back to services and therefore a reduction in the pressures on the commodity or demand for goods, relatively speaking. So that is something to keep a watch on as COVID subsides or revives to some extent, and as vaccination proceeds. And in this context, I should say specifically for India which follows from our analysis of the COVID, that you may get spurts like you're seeing in Kerala and the Northeast, and the slow, and the inability to reduce it very sharply, as it seems to be happening in Maharashtra. But I do not expect a third wave until there's a new mutation. There is no way I or anybody else can predict a new mutation. But what I can assert is that conditional on there being no mutation which is similar in intensity and different from the Delta, you will not see a nationwide third wave. You will see regional variation depending on actions of the people, the public, how they react, how much vaccination happens, but you will not see a nationwide third wave unless there's a mutation. And if there is a mutation as deadly as the Delta variant, which is not containable by the existing methods, for example, the vaccination, then only you will see a third wave. And if that could then be as deadly as the Delta, but otherwise no. So that is an important. And the second element of this, which there was, as I was saying, the disagreement is the urban-rural divide. From our COVID, the Delta model, the S-curve which we had, we said that if anything, the bias was on quicker spread in urban areas. I have seen no evidence to the contrary. All the evidence we have so far, whether you, of course, given again the limitations of data, but limitations are limitations. You have to get counter evidence to that. I see no counter evidence to show that rural spread has been any faster than urban areas. And on the basis of that, and given that agricultural prices were higher internationally, domestically, and there was a good harvest, I was saying that the rural areas would not be badly affected. In fact, my bias was that there would be a positive rather than negative compared to the overall economy. So that, as far as I have seen so far, there is again no contrary evidence to suggest that somehow the rural recovery will be much slower than the urban. I'm not necessarily saying there's evidence to show that it will be a bit faster, but there is no evidence so far to show that it will be slower. There is, of course, an income distributional story there, but because much of the COVID deaths and the COVID severe infections affects urban areas, the low middle class, except for the migrants who had already gone back. So if the migrants were here, they may have been as severely affected, but many of them had not returned. I believe the number is something like 40% of the migrants had not returned back to the urban areas. So in some sense, if my theoretical framework is right, they were less affected. not more affected by the COVID. So in that sense, I don't see a big negative in rural versus urban. And finally, the overall GDP then, after all this, if I put all this together, the exports, investment, consumption, and government actions, as I said, that I expect still to be within my predicted range of GDP. Now, very quickly on the interest, I think I can say it, I won't be revealing most people are in agreement, but let me give my view that monetary policy will and should remain rate unchanged and even guidance unchanged. So I expect no change in that thing, but I would just add a caution for the RBI and the government, which is to watch out for capacity destruction. I think that's now destruction is too strong a word, but it's a depletion of a thought, because if there are informal economy where their resources are depleted, as we have already analyzed and everybody has analyzed, then restarting may be difficult. So the government must watch out for sectors and industries, mostly in the services, where capital depletion, not capacity destruction, but capital destruction in a sense, even working capital, they have to be prepared to do something to inject this capital into new areas, because this is not the standard people coming to the standard bank accounts, but they may be informal sector people who never borrowed from the formal sector, etc., where they may need to be a window. Otherwise, it could unleash again, because of lack of supply, some kind of inflationary pressures. So the RBI and government should watch out for that. Sorry, I've taken perhaps a little more time. With that, let me hand it over to the first panelist, Shri Sachindra Nath, Executive Chairman and MD, EGROW Capital, who will speak first. To
Thanks.
you, Mr.
Thanks, Dr. Virmani. This was very enlightening thoughts which you presented. Coming from the background of a non-bank finance lender, which is dedicated for the small business financing in India, and trying to build India's largest financing platform for micro SMEs in India, I think so. The expectation from the monetary policy, I will only talk about what as a lending institution we expect and what need to be done. While on the rate, there are 3 points. One, we have seen that the rate transmission, which is expected to happen, which benefit the underlying small business customer, does not necessarily happen whenever there is a rate cut which happens. Not that we are expecting that to happen this point of time, but whenever that happens, the source of capital for non-bank finance companies predominantly in today's world is banks, and that does not get translated to NBFCs. And also there is no regulatory framework for that to be further transmitted back to the underlying small business customer. That's point one, and something need to be done. As you will recall that in the last monetary policy speech, there is a differentiated regulatory framework which has been talked about, and there is a draft which is out that has yet to be implemented. And also in the last policy regime, under the temporary liquidity scheme, which is TLTRO, NBFCs were included for the first time. But the mistake or the assumption which we make that providing cheap liquidity to the banks would in turn would become make liquidity available for non-bank finance company. But the fact is that today banks are at an excess liquidity of more than 6 lakh crore. So liquidity is not the challenge. So any monetary policy measure which only provides further liquidity back to the same banks would in turn not create liquidity for NBFC. It has to be a combination of improving the risk appetite, and which would require central bank to step up and either participate in the risk, which is current regulatory framework does not allow, or find out a way that how a systematic mechanism of providing liquidity to this entire large non-bank finance company, especially those who are focused for the underserved market in the time of pandemic, should be provided. So as you know, most of the banks have the RBI window for gaining liquidity. NBFCs don't have it, and that's why even if the NBFCs who want to provide credit support in difficult times and who have the ability to underwrite credit, they don't have confidence that, at an appropriate time when the liquidity is needed, banks would provide that. So I think that these two are the core, need or expectation which is required. Now we all know that MSMEs are the worst hit segment of the market during the pandemic, and that's why there is a very serious risk aversion from all credit institutions. But I can tell you as a practitioner's experience that this is also a sector which does V-shaped recovery every time, when the pandemic recedes. The reason being because a small business is a business which is born by an entrepreneur and whose livelihood is dependent. And I'm talking about the MSMEs, not the large SMEs. And that's why the MSME as a unit and its entrepreneur make all the effort to come back to normalcy. So both in pandemic 1 and pandemic 2, we saw a very strong V-shaped recovery as we saw a very sharp decline. Yeah, but there is a complete credit aversion because banks generally look at from the spectrum of all what is happening, and they have lending portfolio across large corporate, mid corporate, multiple other things, and that may not necessarily reflect the true credit behavior of small businesses. So we have to figure out a way to motivate liquidity in the hands of financial intermediation through NBFCs. And RBI, through multiple policy measures, have to start seriously thinking about bringing NBFCs, at least some segment of the NBFC, into the direct liquidity, support from them, either through on their own or creating a sovereign vehicle participating that. But something need to be done. Otherwise, we will continue to see SME as a segment of the market suffering from lack of credit and lack of liquidity. Thank you, Dr. Viman.
Thank you. Before I call on to speak, let me make clear that, if you have contrary evidence, please don't feel constrained by my views. There may be evidence which contradicts me. I'm very happy to hear any new data. So please feel free to give opposing views, because that's what makes it interesting. So with that, let me invite Upasana Bhardwaj, Senior Economist and Senior VP, Kotak Mahindra Bank.
Thank you, Dr. Virmani. Yeah, so I would largely begin with the situation which we think, in terms of how inflation is looking like. Couple of things you did correctly point out. One is the supply side disruption, which is not India-centric. Clearly, it's a global phenomena. We've seen that across the board. And of course, that will subside at some point of time. Now here also again, the shift which is going to be happening from the goods to the services led will be a function of ease of restrictions, whatever the localized restrictions would be, the pace of vaccination would be, all of that would be happening. But the fact is, with easing of restrictions, with economic activity picking up, with vaccination drive picking up pace, so will demand start picking up. So as we see some supply side price pressures coming down, there is an underlying demand pressure which will also be there. So I think what that means is that there is going to be a floor which is going to be set for inflation, and I don't expect that to really fall dramatically. So we may learn how to live with that higher level of inflation. That's a different situation. But from where we see, there are two aspects to keep in mind. One is that these supply side disruptions are lasting much longer than what anybody has been anticipating. So it's just going on and on. So this is one problem. It's persisting for too long, which has the potential of making it much more generalized. Because prices are typically much more sticky, and we may not see the reversal also equivalent. So while the upside happens, spirally up in a very sharp manner, the downside may not be equivalently, we may not see an equivalent downside in prices. And at the same time, when demand starts picking up, that demand supply mismatch will still probably remain. So I think that's where the price pressure I do see being a much bigger problem, going ahead. Of course, that's a different thing that right now we will have to focus on growth. So we should go very slow on managing this, and it's going to be a very, very they'll have to tread very cautiously, the policymakers. But I think price inflation will become a challenge over the medium term for sure. So that is one side. We are looking at, of course, if I just give our inflation forecast, clearly the last two readings, we had north of 6%, above RBI's upper band threshold that they're comfortable with. But having said that, July reading is clearly looking closer to 5.5% or so. So we are seeing a significant downward move there. Food prices are showing at least a high frequency absolute levels if we look at, and that's showing a reasonable correction. So we are seeing the momentum come down to that extent. And now, henceforth, prices headline, rather, I should focus largely on headline. So the headline CPI inflation trajectory probably would remain broadly below 6% unless there's a major adverse shock. So for that, again, monsoons will be crucial on the food side. There has been a revival in monsoons. The Kharif sowing is gradually week on week showing signs of improvement. So clearly there is some optimism to take from here, but it still remains on uncharted territory because next 1.5 months monsoons are going to be crucial for us to really be very confident on the food inflation trajectory. So, because we should not forget that there is a major element of imported inflation coming on vegetable prices, vegetable oil prices, etc., which is going to be sticky unless we don't really see reduction in excise duty for the petroleums or duty cuts for vegetable oils, etc. So unless that doesn't happen, structurally for a long period of time, we might see that supply side inflation really persisting, which will result in a generalized inflation. That's where my worry remains. On the growth side, clearly the positive contributor is exports. We are seeing a reasonable momentum there, and that is again picking up across the board largely. If we look at April to July, current account overall, not just trade but services included, total current account seems to be broadly in surplus between April to July. So that's again a positive thing, which is going to be a positive contributor to growth. Apart from that, where we stand today, I think government spending is going to be very crucial in the near term to support growth. We have earlier as well talked about the differential or the multi-speed growth across various sectors. The good doing better and the worse getting worse. In terms of informal sector, we don't have as much information, but things are not as good. But the rural economy per se, Dr. Virmani also mentioned, I think it's not as badly affected as probably was getting feared, earlier because of the spread of COVID infections earlier. At least for now, if we look at the rural unemployment rate, it's lower than the urban unemployment rate. If we look at the rural sentiments versus the urban sentiments, the rural sentiments are picking up much better and much more compared to the urban sentiments. So we are actually seeing still a relative outperformance of rural, whatever little early indicators that we have from latter part of June to now to July. So last 1 month, if we can say. Things are looking comfortable in that sense in the rural side, but we'll have to see how much can this sustain beyond a point. So that is going to be important. But exports, I'd like to highlight the recent reading that came on a monthly basis. $35 billion is a very good development. If we can sustain this monthly momentum, then we will surpass the 400 billion target that the government has set for this year. So we'll have to be, of course, watchful. There are various reasons that we are witnessing, because of which we are seeing a shift in demand. Probably there's a major pent-up demand from the global side because the economies are opening up. So all of that is happening, apart from, of course, diversification. So I think that is going to be very crucial to watch out for. If we can sustain a $35 billion per month run rate of exports, that's going to be very good for the economy as a whole. Government spending, I think, will be important. They have budgeted a fair amount of capital expenditure. The run rate also looks good for now because the revenue expenditure is weak compared to last year, but the capital expenditure is relatively better. Having said that, the government is still not spending as much. The cash balances which the center has, the surplus, not just the center, I should say, but center plus state overall, they are sitting on close to 4 lakh crore of cash balances. That is where eventually in the rest of the months they will have to spend to ramp up demand and investment. So we'll have to see how that really pans out through the rest of the year. So we are looking at 9% with a slight upward bias to growth. I think somewhere in the range of 9 to 10% is where I would zero in on, depending on how this third wave impact, which now the projections are coming that within a month or so the third wave is hitting India, with the peak which is going to be much smaller. So the peak occurring in October. That's the new projection that is being that is coming out. Of course, parallelly there's a Sero survey which shows that 68% of the population in India has kind of got antibodies against this infection. So we'll have to see how the impact would be really. But I think somewhere in the range of 9 to 10% is the growth expectation that we are going with. Against this backdrop, I think where we stand, clearly, it is going to be a tall task for RBI to manage this, because growth is picking up momentum, let's say. And inflation is, if we look at where they stand, last two readings, what is available to them is north of 6%. So it is going to be a challenge for them to just manage that tone, the guidance. No expectations on rates, obviously. It's going to be a status quo policy. The question will be, how will they manage the tone of the policy statement to provide a guidance as to what they really intend to do going forward? I think that is going to be very crucial. Another important part would be that even before the 6% plus readings that we got in the previous policy, we did see one or two policy members in the minutes sounding extremely hawkish. And what will their stance be? So does this mean that we could see a split in the voting pattern? That is another important thing which I'd like to, probably look into once we get the statement. So apart from the statement, the tone, I think the split voting also is a risk, which I would say, which is nothing but a starting point of the policy normalization. Third thing I would just like to highlight is, just purely from this policy perspective, is the RBI has started accepting the fact that we are going to be in the process of normalization. And one of the ways in which we can draw cues is that earlier for the 10-year, let's say, RBI was looking at the GSEC bond yield. They were very sticky about managing the 10-year yield closer to 6%, plus minus there. The new benchmark 10-year, which was issued, came in 10 basis higher, and they have let that also go higher than that. So somewhere RBI is letting loose the hold that it was keeping on the bond market, so cost of borrowing for the government, which is kind of providing cues, I would say, to the fact that they are in they're taking the step forward towards policy normalization. So not in August, but I think post that in the subsequent meetings, different forms of normalization. It is not talking about a repo rate hike really. It's more about the liquidity related policy normalization, which will start after the August policy. Yeah, that's it from my end.
Thank you. I guess if I was to summarize the difference, which is that the fears of, it can actually be just called a judgment about how much is temporary and how much. There's obviously, it's never 0-1. So the question is how much is temporary and how much is permanent. So you feel that there is maybe more of a permanent persistence, as you called it, and that's a fair judgment. But the only question which I would have, but maybe we'll come back to it, is that the oil price effect. Could be a one-time thing. I don't know enough about the edible oils. Where is there some inflationary process going on internationally, which is going to be again persistent? So those two issues, if you very briefly want to say, otherwise we'll come back to it.
Yeah, very briefly, globally, the food prices have been elevated and for a long period of time now. So we have already seen palm oil prices, etc., already being very high globally, and that pass through is happening. So if you look at the India edible oil segment, we are seeing inflation in the 30-35% range now at this point in time, and also at the same time, the duty structure is where it can be tweaked to offset the impact of the rising commodity prices. There is a slight easing that has happened lately in the global prices, but that is not enough to offset the increase that has already happened in the past. So the impact is already there, and we can offset that upside by reducing the duty on the edible oils. That's one thing. Of course, the other aspect is the petroleum price excise duty, which I think everybody knows that the prices need to be 55 to 60% overall are the taxes. So somewhere, if 5 to 6 rupee reduction happens, then we will see some reduction in inflation. But again, that will not be meaningful really to an extent.
Yeah. Okay. Well, we'll come back and discuss. So let me now invite Abhik Barua, Chief Economist and Executive VP, HDFC Bank, to make his observations.
Yeah, thank you, Dr. Virmani and Charan. I'm just going to sort of make a couple of observations because a lot of the ground has already been covered. On the issue of inflation and the mix between the transient and the more persistent or durable component, I sort of would tend to agree with Upasana. I think we are seeing a number of categories which have been sticky for far too long to be comfortable with. And I think also, since you brought in the issue of the US and the inflationary process in the US, I think the broad basing in terms of the number of major contributors to the inflation build-up here is significantly more than the US. For instance, if you take the case of the US, 33% of the contribution on the spike really came from both used cars and new car sales, which were clearly a play on the semiconductor shortage that was plaguing a whole bunch of industries, and particularly autos. So I would tend to kind of agree with Upasana's characterization of the problem. And I am again on the same page as her in the sense that there is some implicit normalization that the RBI has set in motion. Perhaps we need to start a conversation, given the risks on growth, and we are not very sure because I think the risks both come from the possibility of another wave, hopefully not a mutation. And also, I think, let's not be too sanguine about export prospects, because with the Delta variant spreading across the world, including China, which is a pretty big buyer, there could be some, while you have a structural substitution driven by the need for diversification and better risk management, and you're looking at India as an alternative sourcing base, there is also a cyclical element to it. And I think the jury is still out on where this Delta variant is taking us. And, it's sort of a mixed picture because the UK's experience seems to be very different from that of the US. Of course, the vaccination rates are different. Israel has had its own problems, so forth. But so we really don't know. So this is today's policy making in today's world is all about looking at risks and looking at the balance of risks and comforts. And I think I would look at that as a risk. And again, taking off from what Upasana said about the large cash balances, one of the domestic risks that I see is given, I think, the kind of the bent of mind that the government has, which is sort of partly changed and modified in response to the pandemic. I think there is an underlying, hawkish fiscal hawkishness in government. So I think, premature fiscal consolidation. So when the taxes are coming in, suddenly you decide that, look, I mean, I'm going to show a better deficit number, or I'm going to use the cash balances to pay the states for the GST loss, etc. I mean, I hope that doesn't happen, and I think that is a real risk going forward. I just hope the government realizes the need for both capital expenditure and some revenue expenditure to keep the machine running. And finally, I think I, sure, uh, I completely agree, and this is something that I've been talking about for a very long time, and I agree with Shachindra, who talked about the difference between just infusing liquidity and ensuring delivery, and the role of the central bank as a risk absorber in the system when there is so much risk, and the success of countercyclical or counter shock monetary policy both in the US and Europe, and also in the UK. You have to sort of mention UK separately these days post Brexit. So has been a combination, of course, of very loose monetary policy, but also of very clearly defined mechanisms of ensuring that the money reaches the small businesses, the dispossessed households, and so forth, and also education loans, for instance. So there are processes that are available. There is a playbook. There is a process of securitization, creating an SPV, perhaps using a government guarantee on that, and then the RBI picking it up, because just simply infusing liquidity is it doesn't help beyond a point. I am not, again, as confident as you are on the rural side, and I'm so happy that Siddhartha is here, who can sort of give us an idea of what is happening with the microfinance institutions and so forth, because one hears fairly disturbing news about collection rates and so on. I was just looking at some of the FMCG surveys. I think the point is that the rural economy might not have been as badly affected as we thought it might be, but it hasn't really been as insulated as in the first wave, and the rural economy is a mixed bag. So if you just look at things like two-wheeler and tractor sales, and if you look at it company-wise, you have one company, say Bajaj Auto, doing fabulously, and another company, which is the same sector, which is selling a product, two-wheelers, primarily a rural product, which is done pretty badly. So I'm not very sure, and I don't have enough information to gauge what is happening in the rural sector. But what I hear from people within the bank and so forth, that the rural story might not be as bad as it was anticipated to be or feared to be, but it's certainly not it's not really roaring. What is roaring, in fact, if you look at FMCG sales, for instance, and a couple of other categories, are the tier 2 cities, which have done extremely well in the recovery process. And I would draw your attention to the BizCom survey and I think the Kantar survey. Anyway, to cut a long story short, I would expect the RBI to retain its stance, not to hike rates, but start a conversation, and a conversation which clearly points to the fact that whatever action they will take will be contingent on how things pan out. But I think to dismiss inflation as largely transient is perhaps not the the unsolicited advice that I would give them. So I would stop here.
You don't want to give a GDP forecast, because
Well, we have
yeah.
we have it. So let me just talk about the GDP forecast. We've stuck to 9%, 9.1% is the number. I don't know. I kind of am a little embarrassed to have these
That's
decimal
okay.
points around it. So
It's okay.
so
Fine, good.
uncertain. So at 9%, so broadly in your ballpark,
Yeah.
9% plus minus, plus 5.5% maybe if there is
Okay.
a serious upside, and with a major risk, maybe a 0.25 on the downside. And inflation, I think we're a little more concerned than Upasana. We are looking at it broadly around the 6% neighborhood, with some relief in October, September, and October. And then the March inflation number, from what I remember, is 5.7%. So that's where.
Okay, thank you. Yeah, so that's good. Yeah, I mean, looking forward, actually, I didn't say anything about forward. I basically gave a past analysis because forward depends so much on judgment. And it's good to have a variety of judgments, definitely. What should I point out? Yeah. So I think the interesting point you were making was the comparison. Yes, I think those are always useful. Why, the US may be less sticky than we are. Yes, I think that's a valid point. And what else? Yeah, the fiscal hawkishness. I think that warning is also always useful, because one is never able to really predict what the government is going to do. They get subject to all kinds of things. Yeah. Okay. So yeah, but this mechanism thing, maybe we can come back to it if we have time. I'm not so sure what the mechanisms are. It also relates to the point I made about watching out for, when the revival starts, watching out to what is happening to the informal sector and what can be done about it. I'm not so sure, but maybe we can come back to that. And maybe
Right. Just one point. I think
Yeah,
in the
sure.
second package, and Upasana and Siddharth can help me with this. I think we created a mechanism by which, through an SPV, the RBI could subscribe to some bonds directly, which would amount to direct lending to the small scale sector. So there's been a small effort on that front. So there is a precedent.
Okay,
I
no,
forget
I'm not right.
Yeah.
Yeah,
Sorry.
so maybe
I'm
somebody, maybe somebody who has more knowledge can tell us later. But let's go finish the two panelists and we'll come back to it. Yeah. So with that, let me invite Siddharth Sanyal, Chief Economist and Head Research, Bandhan Bank, who I'm sure can give us a better perspective on the rural areas, because it's probably the closest. The only thing I would like a little clarity on, which I get a little confused, is that in my way of thinking, whether it's tier 2, 3, 4, 5 cities, they are still urban areas. And when I presume to talk about rural, I'm talking about something besides that, but that's okay. I mean, because the data is so imprecise, I can imagine there'll be a lot of confusion. But anyway, go ahead.
Yeah, thank you very much, sir. Thanks for getting me in this particular forum. And we'll try to just touch upon a few points because on a lot of points that Abhigda or Upasana has mentioned, we are on very similar page. No point trying to get into the details on those areas. Just to tick some of the initial boxes, obviously, we also don't expect any change in the policy rate in this particular round. In fact, we do continue to think that the policy rate will not be changed anytime, definitely in this calendar year itself. We can come to the discussion of the longer term little later. Obviously, no change in the accommodative stance also in this particular round. And a 6-0 voting is our baseline scenario for this particular policy, which we do think that eventually, as we come closer to the end of the calendar year, or definitely by the end of the financial year, there might be change in the voting pattern, but not in this particular policy. So accommodative stance, 6-0 voting, and no change in policy rate is a view for this particular policy. We'll come to our forecasts of inflation and growth rates, which both are relatively more conservative compared to the market consensus. But talking about the rural development side, yes, the way you mentioned, I think that's a pretty nice summary. Basically, what we sense is that the situation seemed to be a lot better compared to when we had last assembled in this particular forum about 2 months back, because at that particular time, the pandemic was still kind of unfolding. But at the same time, even if it is significantly better compared to what was being feared a couple of months back, it's definitely a lot worse on the rural side compared to what was the situation about a year back, or generally what has been the expectation on the stability or the resilience on the rural side on a long-term basis over the course of the last several years. So basically what we figured out this time, once more, that when it's a more steady state movement for the overall economy, the rural segment, the rural growth picture is within a much narrower band compared to the urban and some of the other segments which are linked more to the global growth process. But when there is some disruption more in the form of physical movement, because they are very, very heavily dependent on the physical movement part. So whenever there has been any disruption on the physical movement part, the volatility component is going up dramatically. And that's why 2 months back, the volatility aspect was dramatic. Now we are seeing a bit of that is improving. But here also the important thing is the relaxation on the mobility aspects and the so-called lockdowns, are the way things are unfolding on the relaxation side is also very different in various parts of the country. For example, on the eastern and northeastern sides, particularly in the northeastern side, the lockdowns, etc., are significant challenges even now. So we do a lot of business there, so we get regular updates from that particular side where lockdown and restrictions are very stringent even now. Which is not the case in some of the other areas on the western side or northern India. Thankfully, the bigger economic zones are there. But having said that, so far as the overall rural movement is concerned, I think this will be a very significant aspect. So basically, what we are seeing, so to try to summarize the rural fortunes at this moment, we think going ahead, if I just some kind of at the cost of some bit of oversimplification, what we get to see that if I try to have a P&L and a balance sheet of rural India going ahead, possibly on the P&L basis, over the course of the next few months, we will see continuous improvement, assuming there is no very strong third wave or etc. and no strong lockdowns, etc. Most probably we'll see continuous upliftment so far as the P&L is concerned. But the balance in terms of a balance sheet or their asset base, even though this was not didn't really deliver any direct shock to the physical assets, etc. I think overall their financial health has taken a significant beating in several pockets of rural India, because they were possible. The way we see it, that some kind of natural calamities, etc., take place or impact them off and on. But this has been slightly unusual that 2 consecutive years, they seem to be facing very big dent in terms of not having income, getting into slightly higher indebtedness in certain pockets, etc., etc. So that has been a real challenge. Thankfully, the weather god had been slightly more favorable to them at this particular juncture, and the expectation about agricultural income still seem to be relatively better at this moment also. So if that continues, that's the rope they have to cling on to very, very tightly. But a lot will depend on that going ahead over the course of the next 6 months or so. So even though there is gradual improvement in terms of their overall activity, it might take a longer while to come out of the hit in terms of their overall financial prospects, etc., indebtedness that has come over the course of the last 15 odd months, I would tend to say. just trying to touch upon our forecasts on growth, inflation, etc. I think one interesting factor, if I look at the in terms of the last RBI policy and the professional forecaster survey, there is about 32 professional forecasters who are covered here. And in the last survey, the GDP forecast was in the 9.8% kind of a zone. And the minimum forecast was 7.7%. I think compared to that particular scenario, we are significantly more conservative. Maybe I am getting influenced to some extent looking at some of the movements in rural segments, as well as the take that we had discussed at length in terms of our take on the recovery in consumption. So consumption, if I look at even the urban consumer sentiment, is still languishing close to 50, in fact, less than 50 as in terms of the latest set of RBI survey, which even in the pre-COVID level used to be in the zone of 85 to 90. It hasn't really improved even when there was a reduction in movement restriction, etc. So we don't really see that improving significantly. So 2/3 of the economy will be moving at a relatively slow pace, still remains our baseline scenario. Yes, the prospects about exports is slightly better in pockets, but at the same time, that's a very, very uncertain zone. So will not rely too much in terms of pegging our expectation in terms of a recovery based on exports only. So basically what is happening at this moment, given the uncertainty we had at a much larger scale last time, I had mentioned about a possibility of a GDP growth at sub 8% also. From that point onwards, we are possibly seeing the uncertainties going down a bit, but still I am at around 8% kind of a GDP growth for the full year and not beyond that. In terms of inflation, we are at around 6% by and large. Now, the important thing here is inflation forecast for the same set of professional forecasters were about 5%, and people had a lot of, the degree of comfort in terms of forecast on the part of forecasters has been very significant, because the highest level of forecast in the last round was at around 5.5%, which seems a big challenge at this moment. So somewhere for the market also, there has to be a bit of a realignment so far as the inflation numbers is concerned. Still, we don't think there is any way the RBI can be less supportive to the overall growth momentum in terms of their support and commentary, etc. So they have to continue finding newer ways that how exactly they can provide soothing efforts to the markets and the economy, even when inflation numbers are so high, close to their upper tolerance band, and occasionally even beyond that upper tolerance band. So that's the set of forecasts from my side. As the discussion was going on, I was noting down a few points. Definitely, we are much more worried on the inflation side last few months, just because of the factor that so occasionally, often we do talk about this particular factor, that this inflation is due to food inflation. Now, and typically people tend to take a lot of comfort that food inflation will change its direction relatively quickly compared to some of the other segments or so-called core inflation. But within food inflation, the important point here, it's very difficult to take that much comfort this time, because the drivers within food this time is more like edible oils, proteins, pulses, which are inherently much more sticky compared to some of the other volatile food components like vegetables, etc., who go up very quickly and come down within 2 months. It's not an inflation only driven by that, rather than the stickier components is also very, very important in this round. So that's why we are a little more conservative on the inflation front. And the last point I would like to touch upon, which Abhik also mentioned very clearly, that there is an element of fiscal hawkishness, and there's a discussion which Upashana also mentioned, that whether the cash with the cash balances, etc., whether they can speed up their spending, etc., going ahead in the next few months. Our concern here is that in terms of why we are a lot more conservative in terms of the overall growth number. Also, another component is G, and within there we think that one is their stance, the government stance, about to what extent they can relax their fiscal position is not very clear. And the other thing is, in this kind of an environment, it's not really a switch on, switch off situation for them to speed up fiscal spending also. There is a lot of physical component or physical activity driven element associated with it. And even if they want or in principle decide, even that seems to be a challenge, but even if they decide at some point of time, we might go a little faster, it's not that every machinery down the lane start moving that fast, that quickly. So might actually be a slightly delayed process as and when the government, if and as and when the government take that particular, relax that particular stance of theirs. So I'll stop here and happy to take questions if any.
Thank you. I'll just highlight a couple of points. One, of course, is I think the interesting analogy you made that two consecutive, in a way for the rural economy, it's like two consecutive years of shocks. And the thought immediately came to me, the two consecutive droughts analogy, where exactly this happens, indebtedness goes up, you have wealth effects, and then
Yes.
they try to rebuild their wealth. I mean, it's really negative to positive, but in economic terms, it's the same. But yeah, so I think I have not really gone. I used to be quite used to look at these things very carefully 20 years ago, but it'll be interesting to see what actually happened in the last two times after double droughts. Where especially in the areas where the droughts were severe, which is in a way what is happening, what you're saying, that in Bengal or Eastern India, it's almost like a double shock, one after the other. So I think that's
correct, sir. So the only saving grace here compared to some of the natural calamities had been that there has been no major damage to physical assets per se.
That's right.
And generally the weather god had been somewhat more supportive. So we need to see to what extent it assuages the situation.
Right. So the point is that it would be interesting to use those analogies or look at the data again to see what happened actually. I'm just making,
Sure.
I mean, it's a good point. So the second, I think here I'm, again, I'm not sure, but, one of the things, at least, in the last shock, the first wave, so to say, one heard, because some of the proteins, you mentioned protein. So the thought came to me, I remember reading that in Panipat or somewhere where nearby Delhi, there are these chicken farms, and they'd all kind of gone hut, so to say, for what reasons, lack of demand, disruption of demand, etc. So it actually relates to my point about revival. If there's capital depletion, if because of the sudden stop, it's not clear they can just switch on again when the demand revives. So yes, I think that's again a point worth exploring further. That some of these things is not a dichotomy between food and non-food. It's more of a disruption of the small scale sector, which does not really have that access and couldn't maintain, themselves, so to say, the business going in the when there was a demand disruption due to lockdowns or whatever. So that's another point which I think is worth pursuing later. With that, let me invite Dr. Charan Singh, our last panelist.
Thank you very much. I think we have had a very rich discussion so far. So my job becomes easier. I'm going to just focus on the international scene first, then come down to the domestic. And in the domestic, I'm going to focus more on banking. When it comes to the international scene, there's just been a recent revision by the International Monetary Fund in their World Economic Outlook, where they have revised the estimates of growth for various countries. For USA, UK, and Euro, they have raised it over their previous projections. And these are the three countries which in their recent monetary policy have not changed the rate of interest. In emerging countries, they have again raised the rate for Russia and Brazil. And these are the two countries which have very recently changed their rate of interest, the repo rate. Russia has changed it in July 23, and Brazil raised it in the last week of June. Okay. Now, as far as the global scenario is concerned, the fault lines are pretty clear, and COVID vaccination is the biggest concern in the fault lines. So I would agree with the assessment that has been made, that assuming that yes, the growth rate, global growth rate has been retained at 6% for 2021 and 4.9% for 2022, need not necessarily mean, because of the fault lines, need not necessarily mean it will translate into our exports. So we'll have to be very watchful for that, because the fault lines are very clear. I think Dr. Virmani was very right when he said there is a demand-supply mismatch which is taking place, and because of which the price rise is very transitory and needs to be taken at that. The commodity prices, yes, have played havoc. The oil price itself is 30% higher vis-a-vis December 2020. So that is showing up across the world, including our own country. The debt GDP ratios are rising globally. So therefore, fiscal fault lines are also visible there. India's growth rate has been reduced from 12.5 to 9.5%, and that's the convergence I see between the three market participants who are saying that their projection for India is around 9%. Of course, Siddharth says 8%. IMF is pegging it at 9.5%. For 2022, they are pegging it at, of course, 8.5%. So much for the global scene. Coming to India, within our country, I do fear the third wave, and therefore, and the time for the third wave is nearing. So that fear is there. Now, very less percent of the population has had both the doses. If I'm not wrong, it's around less than 10% who have had both the doses. So there is a differential impact expected. What is showing up in Kerala right now may be developing across the country, and there is that fear always there. Now, as far as the banking scene is concerned, little worried over there. Latest RBI report is telling us in their global financial stability report, in the financial stability report, they are saying, and we are feeling it, that there is a fall in credit, and of course deposits continue to rise the way they were. As far as credit is concerned, there's a fall in it to the industry sector. And in the industry sector, of course, they've given a long-term horizon, 42.7% in 2014 to 28.9% in 2021. And in the industry sector, private corporate sector credit has declined the sharpest, from 37.6% to 27.7%, continues to fall. While the industrial credit is falling, the one on the personal loans is rising. The personal loans, the share of total credit is around 26.3% now, and on housing is 13.8%. While this is okay, the problem then is the delinquency rates in these. The delinquency rates in the private sector banks, which was 1% in March 2020, has increased to 2.4% in January 2021. Similarly, if we look at the HFCs and the NBFCs, the delinquency rate, which was 4.8% in March 2020, has increased to 6.7% in 2021. Now, given this background, my worry is that we have had the second round of lockdown, and then if the third wave hits us, there'll be a third round of lockdown, and then the delinquency rates are going to take a very big hit. So that is one worry which I have. As far as the credit offtake is concerned, as I've already shown that there's a fall in the credit offtake. Again, if there's a second lockdown, the third lockdown, and the third wave, this credit offtake may suffer. That means the balance sheet of the commercial banks are little worrisome, and their gross non-performing assets can become high. And that's exactly where the Reserve Bank has given its projections, where it shows that the gross non-performing assets are expected to rise in the next few months. The April to June quarter results are in of various commercial banks, and what a good study of them shows that yes, non-performing assets in some of them are rising, and that is worrisome. Of course, the coverage ratios are improving. That means provisions have been made. and the RBI's study that the credit offtake could suffer bears out in the quarter of April to June. I think that is where we need to be really worried. The On the fiscal side, I totally agree with the assessments which have been made so far. Capital expenditure of the government is rising, and the multiplier of the capital expenditure is around 4% vis-a-vis the revenue expenditure, where the multiplier is less than 1. So therefore, if the capital expenditure is rising, it shows that there's a probability of expansionary growth taking place across the country. One thing which is worrying me is the higher borrowing. Yes, the latest GST data shows that we have crossed the 1 lakh mark and it has come out well. But overall, the revenue collection is not expected to be high. Borrowings scheduled for the year are high. Now the worry is it crowding out the private sector? And that is where I'm not very clear in my mind. Why I say that is because the IPOs which are coming up and the successful IPOs which are coming up are very large. So I'm not very sure if one of the market participants can explain, that will clarify. But then the crowding out fear is there. Of course, there is a study by the in the economic survey which says that there's crowding in happening in the country. But then my fear is when the economy is shrinking and the pool of savings is shrinking and the government has to borrow, obviously, to sustain the economy, there is every fear that crowding out can take place. Of course, if I look at the data, the high frequency data which is coming out, and the IEP data shows that all in mining, manufacturing, electricity, very good improvement has taken place in May. Hopefully it will continue. And if we look at the use base, the primary, the capital goods, intermediate, infrastructure, consumer durables, all of them have shown a robust growth. The core industries, the 8 core industries, all the 8 core industries are showing a very good growth rate. And all steel especially is showing a very positive growth rate, very high growth rate. That means construction activity and those activities are doing well and housing is doing well. So therefore, there is that positive role, at least the rainbow is available. But then there are points which are the fault lines one has to worry about. As far as inflation is concerned, I totally agree with Siddharth's analysis that there are sticky points. Oil and fats are rising and pulses are rising, fruits are rising as far as the CPI is concerned. But on the WPI, which has just landed up in the double digit, that is worrisome and may, taken both of them together, may put some pressure. Like Russia and Brazil increase their interest rates, may put some pressure on the 6 MPC members. But then, if we look at where the increase has taken place, basically fuel and manufacturing in the WPI. So maybe the MPC members would consider this as transitory and not opt for a change in the interest rate. Overall, my suggestion and recommendation would be that the status quo needs to be maintained. The guidance has to be accommodative and required whenever the RBI just walks into it and takes care. But I also, like Upasana said, start seeing a turning point in the country now. And therefore, when Upasana says she isn't sure if there's a 6-0 MPC decision, I agree with her. There could be the hawks versus the doves debate, and some people may say that yes, they start seeing the signs of higher inflation. The IIM Ahmedabad survey on the business expectations inflation certainly is less than 6%. So yes, a year ahead. So it stays in the band. But then as the trends are and the commodity prices are behaving and the fault lines are appearing, there is a possibility that there's a division in the 6 members. So I would conclude that I expect a status quo and I hope the RBI maintains the accommodating monetary policy. Thank you very much.
As we are well past the time, I'm just going to conclude and then hand it over to you, Charan, if you want to continue with the Q&As, but I'm just going to make a few remarks. We've had this.
I would suggest, Dr. Virmani, I would suggest, given the time, and we have already gone ahead, we would close after your remarks. I'll just give a brief vote of thanks.
Right. So we've had a series at EGROW, we've had a series of monetary experts talk to us on kind of the fundamentals and the empirics of monetary policy. And one of the things which came out clearly, which we tend to generally forget, so I'm repeating it, is that in modern monetary economics, it's basically the issue has now become expectations, So, the trade-off, if you read Krugman or any other, Ben Friedman spoke to us, it's no longer that old framework of the trade-off and the point on the curve. I can't remember the name, the standard curve. And it's more about the effect on expectation. So, given that there is a large excess capacity in the commodity sector, and services in some sense really do not have capacity constraints as such. But the issue, which is why I kind of emphasize, so there are two issues here. One is, will these services be able to revive? For example, we've already seen that there was a big problem in the container traffic. So when the containers were shut down, which we call in economics sudden stop, and then there was a sudden revival. There was a huge mismatch, which led to a big jump. I mean, unprecedented, 100% jump when you had all this low activity coming from a peak. It's really unprecedented. So you get, so the issue becomes one of being able to revive fast. There can be many reasons. One of the reasons which I pointed out in the Indian context, in the global context, it was the nature of the logistic industry, the shipping industry. In Indian context, which I pointed out, was that some of the small self-employed, which, according to various numbers, maybe 50 to 70% of the economy, they will have depleted their capital. So if the service demand revives, will they be able to supply the service demand? So this is a different type of problem. But on the going back to the curve and the expectation, the problem with the expectations issue now is that, if people are very clear that, okay, there's a one-time the price increase, which is an adjustment because the prices had fallen too low because demand had collapsed. If demand is back, they'll come back to some reasonable level. That's still a one-time increase. It is not an inflationary impulse. So it need not affect people's expectation that there will be a continuous rise in inflation. So, and similarly for oil prices. So that's where judgment is very important. I'm trying to explain the differences. There's nothing wrong in having different judgments based on, at least if all of us are aware of all the same facts, because there's nothing perfect about it. In some sense, what we are trying to see is will inflationary expectations come back? Quite possible. Like the 3 of you said, if inflation in India remains stuck at 6%, even though it may be for jumping from one problem to another, why would people expect that it will go down to 5? So they may adjust. If they were thinking it would be at 5 or 4 because of monetary policy actions or whatever, and it gets stuck at 6, that changes in inflationary expectations. So the job, and this is what we've learned from all these talks, is that the job of the monetary authority, then the key job is to cut down those inflationary expectations. It is not to control the inflation because they can't control it. So it's a complicated issue. I'm just saying it's not the standard thing that there is an excess demand. Everybody in the world is the people who follow, whether it's US, EU, nobody is saying there is excess demand because there is capacity. Capacity utilization is down, we keep saying, in US, Europe, everywhere. However, there can be an issue that capacity is shut down. Will it revive quickly enough? How will it affect expectations, etc.? So the point of all this is not to criticize anybody, but there are very difficult judgments when there's so much risk and uncertainty. There are difficult judgments involved in thinking about how, what signals to give, how because of what the expectations are changing, etc. So, I mean, a bit of a theoretical talk, but I just wanted to end with that. And the bottom line is, it is good to have differences of judgment because then you learn the thinking process. That's really what we can do when things are so uncertain. So with that, sorry, Charan, for becoming a little theoretical here, but I was remembering our talks, which were very interesting, actually. So perhaps if people haven't seen it, they should go and on our YouTube channel, I guess they can access those talks. I think Ben Friedman's talk, I also got disturbed because there was some problem in the mute button or something. But that, I think his talk was also good. Okay, with that, let me conclude and hand it over to you, Charan.
So once again, I want to thank the participants for spending time with us. But most importantly, I want to thank the panelists who bring their rich experience, all of them from the market, and talk to us. I want to especially thank Dr. Virmani, who has brought in this new concept. And I am also worried while there's an output gap which is emerging, the point that I was trying to stress when I said that the credit to industry is somehow suffering, and my fear that there's crowding out probably happening in the private sector, my fear. So is there output gap emerging? And will it be able to fill in once we start? And that's exactly where I think Dr. Virmani's comments become very important, where he says that there's a capacity and that capacity should not get destroyed. Somehow we have to ensure it may be sitting idle, it may be unutilized, but should not be destroyed. What all measures are required both by the central bank and the central government is very important. If the third wave hits us, it becomes all the more important that at least that idle capacity is retained and not destroyed. I think with this, there is a consensus. I'm sure there's going to be a consensus in the MPC members also, 6-0. Of course, some of us are not very sure on that, but between us, there is a consensus that this time the monetary policy should stay where it is, and there should be no change, the status quo, and it should continue to be accommodative. We have also discussed today, and I'm so happy that again a consensus is emerging there, that the growth rate of the economy would hover between 8 and 9%, and that inflation would be around 6%, probably less than 6%. With that, let me conclude and thanks everyone for being with us today. Thank you, ASSOCHAM, for organizing this important discussion. Thank you.
Thank you so much, sir.
Thank you.